Good morning, everyone. It is Tuesday morning, 9 a.m. Welcome back to this week's edition of the Merkle Market Update. I'm Warren Merkle of Merkle Retirement Planning. Today we're going to be talking about this topic called risk clarity. What is risk clarity? How you maintain risk clarity in your portfolio in the short term, the long term, and why is risk clarity even important at all? First of all, risk clarity is how much risk are you taking in your portfolio, which means when we go through market conditions like what we're going through right now, how do you anticipate your portfolio to react? The unfortunate part about risk clarity is that it usually takes an event like what we're going through for people to understand how much risk they really are taking. If you have a $100,000 portfolio, we go through market volatility like what we're seeing right now, would your portfolio lose $50,000, $20,000, and more importantly is how does that impact your planning? Now, if you're 30 years old, you're 40 years old, what you're seeing in this type of a market condition is your 401k balances, your IRA balances declining. You're not anticipating needing to use this money for another 20 to 30 years perhaps, so it's not necessarily changing your lifestyle from a market condition standpoint. This is really important. This concept of risk clarity is really important if you're within a few years of retiring or already retired. Because it's not just your 401k balance that's going down, it is your potential retirement lifestyle. You've worked for 20, 30, 40 years and you've dreamt about this day far off in the future, maybe 2, 3 lifetimes away, and then you're finally there. And the bottom drops out of the stock market and you're left wondering, what is your retirement picture going to look like? Are you able to accomplish the retirement vision that you've been dreaming about all these years? Unfortunately, every time we go through this type of market volatility, the last one we remember, 2008, when we go through this type of market volatility, people have to come out of retirement, people have to postpone their retirement, and people have to change their lifestyle because they've lost too much money underneath the 401k plan. That is why risk clarity within your portfolio, within your retirement plan is so important. The next time we go through this market volatility, and by the way, we're going to go through this type of volatility many times. Even if you're retired today, you're 65 years old, you've been retired for 2 years, you could anticipate at least a half dozen more events, market events, like what we're going through right now. The stock market and how it's functioning is changing. The stock market and how it works, the amount of volatility is ever evolving. There's this concept called algorithmic trading, which basically is done by computers. Last year I was out in San Francisco and I got to tour the IBM Watson facility, and for an hour they were telling us about how technology is taking over stock market trading. And right now it's estimated in the United States that 70% of trading volume is done automatically through algorithms. And that's only going to continue to increase. So the volatility that we're seeing is going to continue to increase as well. All we have to do is look back 15 years ago, and a 500-point move in one single day was a big, big deal. We have 500 points up or down right now, nobody's even blinking an eye. And that's going to continue to go that way. So this type of volatility has an impact, a direct impact on your stock accounts, on your IRAs and your 401k plans. What we don't want it to do is have a direct impact on the type of lifestyle that you can live in retirement. So we need to be really clear as far as how much risk is your portfolio expected to lose. And what we do is we use technology, and we have a really good conversation at point of redesign of the portfolio. So we build the retirement plan, we redesign the portfolio, and we say, Mr. and Mrs. Jones, you have $1 million portfolio. If we go through a really bad market cycle, we would anticipate that your $1 million portfolio would lose $100,000. How do you feel? Now, realizing that nobody likes to be down. Nobody likes the concept of losing $100,000 or the portfolio being down by $100,000. But when you take risk, when you take market risk, there's going to be some fluctuations in the account. So the question is how much do you feel comfortable with with a fluctuation standpoint, risk equals reward. And then is the amount of risk that you're taking, is it going to make you change your retirement plan? So we have the conversation, Mr. and Mrs. Jones, you have $1 million. $100,000, they feel like they can afford to take more risk and they're going to be comfortable with that. So we keep going. Is it $150,000, which is your comfort zone? Is it $200,000, right? We have this conversation until we all feel really good about the type of risk that Mr. and Mrs. Jones are having in your portfolio, but we can't stop there. That's just the start. We need to continuously monitor how the portfolio is reacting. We need to continuously monitor how you feel about the market movements. And every once in a while, we go through a condition like this. Mr. and Mrs. Jones' portfolio, based on the design, does go down $200,000. And then Mr. and Mrs. Jones are saying, whoa, I know we had that conversation, and we knew that the portfolio was designed like that, but this is way too much in real life. This is way too much in real life. So if you're finding yourself looking at your portfolio performance and seeing that your portfolio has decreased at a rate where you're not comfortable with it, it's creating too much anxiety, there's too much emotions involved, or even more importantly, it is going to change your retirement plan, when you can retire, the lifestyle, how you're going to live in retirement. If it's going to make any of those adjustments, I think you're going to have a good opportunity. The market has been vacillating between 25, 30% down, and then it started vacillating between 20 to 25% down, and now it's somewhere around that 15 to 20% down where it's vacillating on a daily basis. So it's creeping back up in a good direction. And we're going to eventually get to a point where substantially the gains are back, the losses are gone, and now you have a really good opportunity to determine that ride that we went through this year in 2020, was it too much for you? Was it too much for you? We got the portfolio came back substantially, and if you can answer the question, it was too much, affirmatively, now you can make some changes. Now you need to get to work to redesign the portfolio, because again, we're going to have events like this many times throughout the course of your pre-retirement and retirement phase. So it's really important to have a good understanding of how much risk you're taking. When you're talking with your advisor, or you're talking with your spouse, or you're just thinking about this in your terms, it's important to have the conversation, the risk conversation, in these terms. It drives me crazy when I hear conversations like, I'm a conservative investor, or I'm a moderate investor, or I'm aggressive. Because what is conservative to you might be completely different than what is conservative to your advisor. What's moderate to you might be completely different than what is moderate to your spouse. So there leaves a lot of room for error because there's so much subjectivity in that type of conversation. So when you're having the risk conversation, it is important to talk about it in the terms like what we talked about it with Mr. and Mrs. Jones. You have a portfolio that is X, 200,000, 500,000, 5 million, it doesn't matter. Put dollars around it. And when the portfolio goes through a really bad market cycle, based on the way it's designed, the asset classes that are involved in it, based on the characteristics of that portfolio, it is going to go down directionally X amount. And if you feel comfortable with it, then at least you know. Because when you go through market volatility like this, one of the hardest parts is the uncertainty. Most people have no idea how their portfolio is going to react. So they're sitting on the couch watching the news, seeing the market blow up, and they think that their portfolio is blown up, and many times it does. To create a truly recession-resistant portfolio, you have to be diversified, and you have to be in tune to how your portfolio will react when we go through these. So when you're having these conversations, talk about it in terms of the portfolio is going to go down by X, not that you're conservative, not that you're moderate. On a scale from 1 to 10, you would consider yourself a 4. Again, that's very subjective. So talk about it in terms that are really clear. That's going to create some risk clarity with your portfolio. We're going to have some opportunities to take some risk off the table once the markets have substantially rebounded. I think once the Dow gets probably to that 27,000 mark, is going to really represent an opportunity for a lot of people to take a step back and say, that was way too much. I had no idea the portfolio can do that, and now I need to do something about it, and you're going to have that opportunity. But don't wait for that. Right now that you have a good understanding of how your portfolio reacts, put a plan in place for when that takes place. Put a plan in place for once your accounts have substantially rebounded, here's how you're going to go about fixing it so it doesn't do that the next time. We wish you the best of luck. If you have any questions, there's a link. What we're going to offer you at no cost to you is direct access to me, just a continuation of this conversation. What are your concerns? We call it the 15-minute retirement checkup phone call. You have, through that link, direct access to my calendar. So set up a 15-minute retirement checkup phone call with me. We'll have a great conversation and see if we can't add some risk clarity to your portfolio and your retirement plan. I hope you all have a great week. We will see you next week on the Merkle Market